Okay, so good afternoon, everyone. Welcome you all to AG classes. Today, I will be discussing some basic accounting concepts which are very much useful when someone after completing BCom or after completing class 12 from commerce background, they appear for interviews. And I have often seen in the interviews, they basically ask basic accounting concepts. Okay, so some important concepts and other things which are generally asked to the students who are from commerce background that I will discuss today. So the first thing I will discuss in this video, I will be discussing five topics, five things. The first thing I will discuss fixed assets. Fixed assets. Okay. So now when we talk about fixed assets means something which is used in a business for a long time, and every business requires fixed assets because fixed assets basically helps a business to earn profit. So fixed assets are very much needed in a business. So fixed assets is something which benefits a business. Fixed assets is something which basically used in a business for a long time. That is fixed assets. Now these fixed assets are of two types. One is tangible fixed assets, tangible, and another is intangible fixed assets. Tangible fixed assets are basically those assets which is visible, which you can touch. Okay. For example, the tangible fixed assets is building, machine, furniture. So these are the examples of tangible fixed assets, which is very much visible and which you can touch even. When you talk about intangible fixed assets, these are not visible, but it has huge impact in the performance of a business. Examples of intangible fixed assets, you can say goodwill, patent, copyright, trademark. All these are basically intangible fixed assets. Now, what happens? A tangible fixed assets like building, machine, furniture, when you use a tangible fixed assets, its value reduces. And that reduction of value is actually known as depreciation. For example, if I say, if you buy a machine on 1st Jan 2022 for rupees 5 lakhs, definitely if you use it throughout the year, then at the end of the year, that is on 31st December 2022, the value will definitely reduce. If I assume that value to be 4,80,000, so there is a reduction of how much? 20,000 reduction is there. Then this 20,000 will be termed as depreciation. So regarding depreciation, I can say depreciation is a term related to tangible fixed assets. If we use an assets, then its value reduces. And that reduction of value is actually called depreciation. So depreciation is a term related to which assets? Tangible fixed assets. Now the question comes, the value of intangible assets, does it reduce? Yes. Intangible assets value also reduces. And when the value of intangible assets reduces, that is called amortization. AMORTISATION. Amortization. So amortization is also reduction of value, but that's reduction of value in intangible assets. More or less depreciation and amortizations both are same, but the term depreciation we use in case of tangible fixed assets, amortization we use in case of intangible fixed assets. So for amortization, when there is value reduction in the value of intangible assets, that is called amortization. Now, if depreciation is charged, when depreciation is charged on an assets, what journal entry we pass? When depreciation is charged on an assets. So when depreciation is charged, depreciation is a nominal account as because it is an expense. Okay, depreciation is a loss to the firm. So when depreciation is charged on a tangible assets, the first journal we will pass depreciation account debit to the respective assets. If the depreciation is on furniture, then debt to furniture. If it is on machine, then debt to machine. If it is on building, then debt to building. So debt to assets. Then when the accounting year ends, actually, then this depreciation needs to be closed and it has to be transferred to profit and loss account. So for closing entry, we will pass profit and loss account debit to depreciation. So what are the related journal entries for depreciation? For charging of depreciation, debt to assets. And to find out the actual profit of a business, the depreciation needs to be closed. So at the end of accounting period, we transfer this balance of depreciation to profit and loss account. Then the entry we pass profit and loss account debit to depreciation. What are the other related entries? Now, if we purchase the assets, if I ask you for purchase of assets, what journal entry we will pass? Purchase of assets is very simple. Assets account debit to cash or bank. Assets account debit to cash or bank. Okay. So this is the simple journal for purchase of assets. Assets to cash or bank. Now we have purchase and assets. If we use the assets, then its value will reduce. Then we will charge the depreciation. And when the accounting year will end, we will transfer the depreciation to profit and loss. So for closing entry, PL to depreciation. Now this depreciation, there are two accounting methods for this depreciation. The first is simple method, and there is one more method of accounting, that is accumulated depreciation method, or which is also known as provision for depreciation. Now we have to understand the difference between the simple method of accounting for depreciation and the accumulated method of accounting for depreciation. In simple method, what happens? When at the end of the year depreciation is charged, the asset value is reduced. So the journal entry is passed, depreciation account debit to assets. Okay. So here asset value reduces. This is a simple method wherein every year with the depreciation the asset value decreases. But if the firm follows this method, that is accumulated depreciation method, then every year at the end of the accounting period, whatever depreciation is calculated, that is not decreases the value of the assets. Rather, every year's depreciation is accumulated in a separate account called accumulated depreciation account, or you can say provision for depreciation. So what entry we will pass? If we follow this method, then at the end of the accounting period, we will pass depreciation account debit to accumulated depreciation, or we can say provision for depreciation. So see the differences. A firm can follow this simple method or this accumulated method. The basic difference is that under simple method, asset value is directly reduced with the depreciation amount. But when we follow accumulated method, the asset value is not reduced. The depreciation is accumulated in a separate account called the accumulated depreciation account. Okay, so this will follow up every year when the depreciation will be charged. Every year in the simple method, debt to assets, but under accumulated method, debt to accumulated depreciation. Now what will happen when there will be sale of assets? When there will be sale of assets? When the firm follows this simple method of depreciation, then for sale of assets, the first journal the firm will pass cash or bank account debit to assets. And by selling these assets, there can be profit or loss. So for profit, assets to profit on sale, and for loss, we can say the entry will be loss on sale of assets to assets account. So these are the journal entries which are passed in the books of accounts when the firm follows simple method of accounting for depreciation. Every year depreciation will be charged, and at that point debt to assets. This way every year depreciation will be charged, and when the firm decides to sell the assets, then for the sales value, the first entry firm will pass cash to assets. This is the sales value. Then if there can be profit or there can be loss, if there is profit, then assets to profit and loss, or assets to profit on sale, and if there is loss, then loss on sale to assets. These are the entries which are passed when we follow simple method of charging depreciation. Now for accumulated method, when an asset is sold, the first entry we have to pass accumulated depreciation which was accumulating for the previous years, because every year we charge the depreciation debt to accumulated. So accumulated depreciation balance is increasing. Now when the asset is sold, that accumulated balance is transferred to the respective assets account. So accumulated depreciation to assets, then the asset value decreases. Then we will record the sales value, bank or cash to assets. The sales value we will show, and thereafter the profit or loss for same entry will be done. The only difference between the simple method and accumulated method is that under simple method every year the amount of depreciation is subtracted from the assets value. But under accumulated depreciation, every year the asset value is not reduced. The depreciation is accumulated in a separate account. And entire depreciation for the previous years will be deducted from the asset value when there is sale. So there is the difference. So at that point of sale, ultimately both the method come to the same position. Okay. In simple method, every year the depreciation is deducted. Under accumulated method, at the point of sale, the accumulated depreciation is deducted from the asset value together. The rest of the accounting will remain same. So this way, the depreciation is accounted for in the books of accounts. And whether a firm will follow the simple method of accounting or accumulated method, that's up to the firm. Okay, so these are the related discussion for tangible fixed assets. Now I will come to for this amortization, intangible fixed assets. As I told you, intangible fixed assets, when the value of an intangible fixed asset reduces, that is called amortization. So what entry we will pass? We can say like this: amortization account debit to respective intangible assets like goodwill or patent or copyright, whatever you say. And the second journal, this amortization expense has to be written off. So we will write profit and loss account debit to amortization expense. So it's almost similar to depreciation. Only the different term is used. It's depreciation for tangible and it's amortization for intangible. And when it's a tangible, as I told you, there are two different methods for counting of depreciation. One is simple method and another is accumulated method. So regarding fixed assets and its accounting for fixed assets, this part can be asked to a candidate who is appearing for the interview. Okay, so this part is important. I'm expecting that you may be facing this type of questions in your interview. Next part, what I will discuss. Students are often confused. That is bad debt and provision for bad debt. First, I will explain these two terms, meaning of these two terms. What is bad debt? What is provision for bad debt? Then it's accounting. Bad debt is basically the irrecoverable portion of debtors. Debtors, when we sell goods on credit, for selling goods on credit, debtors is generated. For selling goods on credit, debtors is generated. Suppose I, Mr. X, I sell goods to Mr. Y for 50,000. So Mr. Y is my debtors. I could collect 40,000 from Mr. Y, but I could not collect 10,000 from Mr. Y. So this 10,000 will be termed as bad debt. That's why the definition of bad debt is the irrecoverable portion of a debtors. Who is my debtors here? Mr. Y, because I sold goods to him on credit. And what is the irrecoverable portion? The irrecoverable portion is the 10,000, which is bad debt. Now, what journal entry I will pass? When I sold goods to Mr. Y, then the entry is Mr. Y account debit to sales. That is the entry when I sell the goods. Okay. Now, when I collected the amount I collected cash to Mr. Y. If you see the examples, you will understand easily. It's 40,000, the collected amount, you will write cash to Mr. Y. And for bad debt, you have to write bad debt account debit to Mr. Y. So if you are asked what is the journal entry for bad debt, you should say bad debt to debtors. Because Bad debt is the irrecoverable portion of a debtor. So bad debt is a loss to the firm. That's why it's debited. So for bad debt, the first journal entry, bad debt to 1. Now when the accounting year ends, this bad debt needs to be closed. So bad debt will be transferred to which account? Profit and loss account. The closing entry will be profit and loss account debit to bad debt. Thus the bad debt gets closed. Is it okay? So the concept of bad debt is fine. Now we will come to the another term, that is provision for bad debt. Provision for bad debt in accounts, there are GAAP, general accepted accounting principle, and we follow the conservative approach. If there is a possibility of any losses in future, we have to be very much cautious in advance. So what we do, we know it very well. If we sell goods on credit, debtors will be generated. A certain percent of the debtors will not be recoverable. So bad debt there will be. Bad debt will be there. I cannot say this much bad debt will be there, but I am sure that there will be bad debt. So in future, there is a possibility of having some loss to the firm. So what the firm will do as a practice, as a prudence practice, as a conservative approach, the firm will create a provision. Firm will keep a certain amount aside for that bad debt losses, so that in future when the bad debt losses will occur, that losses can easily be set up with this provision which is created earlier. Okay, so what happens? Suppose we are accounting for the year 2022. So in the year 2022, there is a sales, credit sales, and debtors are for rupees 1 lakh. So I'm expecting the out of these debtors, 5% debtors will not pay. I'm expecting. I'm not sure. But from my previous experience, I'm expecting out of 1 lakh, I may not collect around 5,000. So what I will do? I must make a provision for this expected bad debt losses. So what I will do, in the profit and loss account of 2022, I will pass a journal, profit and loss account debit to provision for bad debt. So I created the provision for bad debt. It's for how much? It's for 5,000. Is it okay? So I created the provision, debiting in profit and loss account. Now, in the next accounting year 2023, suppose there is a bad debt loss of 2,000. I expected the loss to be 5,000, but the actual bad debt loss became 2,000. Then what I will do, this bad debt losses have to be adjusted with provision for bad debt. So in that point, I will pass an entry, provision for bad debt to bad debt. Provision for bad debt to bad debt. Okay, this will be 2,000. So one question might come to your mind, sir, just now you told, okay, when bad debt is there, then it is transferred to PL. It would be transferred to PL when there is no provision. If you did not create any provision earlier, then the bad debt losses will be straightway debited to profit and loss account. But if you have provision already, because in my example, as you can see, earlier I created a provision of 5,000 because I'm expecting there will be a loss of 5,000. That was expected. But actually, in the year 2023, I came to know the bad debt losses has been 2,000. So what I will do, I will adjust these bad debt losses against this provision. So the entry I will pass provision for bad debt to bad debt. Is it okay? So this way the accounting for provision for bad debt is done. Now it may happen, sir, you created a provision of 5,000. Suppose the bad debt losses has been 7,000. Then the entire 5,000 provision you will utilize, and 2,000 is shortage. That 2,000 shortage you will straightway charge to where? Profit and loss account. Then this amount will be 7,000. Is it clear? If you have sufficient provision, adjust with that. If you have provision but that is less than your bad debt, then the less shortage amount will be directly debited to profit and loss account. So this way the accounting for bad debt and provision for bad debt is done. So I explained to you the meaning of bad debt, the meaning of provision for bad debt, the need of maintaining provision, and accounting for bad debt as well as provision for bad debt. So two topics I have covered: accounting for fixed assets and treatment of bad debt and provision for bad debt and related journal entries. The third thing I will cover, this is also important, cash basis and accrual basis of accounting. Actually, when we talk about the basis of accounting, there are two bases. One is cash basis, another is accrual basis. Cash basis of accounting, herein we consider an expense and we consider an income when it is earned in cash. But in accrual basis, that's not the case. Even if we haven't paid, then also that may be considered as an expense. I will just give an example for understanding this concept of cash basis and accrual basis. Suppose I'm doing accounting for 2022. Fine. I'm preparing the profit and loss account for 2022. This is under cash basis, and in the right hand side, this is under accrual basis. This is accrual basis and this is cash basis. Now, I have paid salary to one of my staff. Salary paid to staff, 10,000 per month, and I have paid it for 11 months. So a year consists of 12 months because the accounting year is of 12 months. So salary paid to staff 10,000 into 11, it becomes 1,10,000. So when you do cash basis of accounting, then salary to be debited to profit and loss to salary, the amount you have paid in cash, 1,10,000. But when you follow accrual basis of accounting, then we will not write to salary, the salary paid in cash is 1,10,000, but 1 month salary is outstanding because a year consists of 12 months. So here we have paid only 11 months salary. So 1 month salary is outstanding, that is of 10,000. So that 10,000 you have to add here, and in the profit and loss account you have to show as salary 120. That means under accrual basis you have to consider outstanding and prepaid, but under cash basis you don't need to consider outstanding and prepaid. The amount which you pay in cash, that is your expense. That amount which you receive in cash, that is your income. So cash is the matter of concern. But under accrual basis, how much you receive in cash, that's not important. You are accounting for 2022. So any expense which relates to 2022, you have to debit it that in the profit and loss account, whether that is paid or not. As in this example, as you can see, the salary paid is 1,10,000. That's for 11 months. 1 month salary is not yet paid. But accrual basis says, since this 1 month salary is also relates to 2022, so you have to show it, or you have to consider it as an expense of 2022. So that's why 110 I have already paid, 10 is outstanding. So entire amount of expenditure salary is 1,20,000. Okay, so cash basis of accounting, it considers only cash. If you have paid cash, that is expense. You have received cash, that is income. But accrual basis says you are accounting for 22. So anything relates to 22, whether it's paid or not, that has to be considered in 22. Any income relates to 22, whether received or not, that has to be considered as the income of that year. So accrual basis is rather more logical than cash basis. If you want to calculate the real profit or loss of a business, you should follow the accrual basis of accounting. Okay, and for a company, for your knowledge purpose, I must say, for a company, following of accrual basis is compulsory. A company cannot maintain its books of accounts following cash basis of accounting. Following accrual basis or market time system of accounting is compulsory for a company. Okay, so this example will clarify the concept of cash basis and accrual basis of accounting. 3 things I have discussed: accounting for fixed assets, treatment of bad debt and provision for bad debt and related journal entries, and concept of cash basis and accrual basis of accounting. The next thing, liability versus provision. These questions often asked. Liability versus provision. What is liability and what is provision? Liability means which is certain. Liability means which is certain. I know, okay, I have to pay this much amount. Suppose I purchase goods from Mr. Y. Purchase goods from Mr. Y. Purchase goods from Mr. Y. Okay, so for 50,000, I'm taking the amount to be 50,000 on credit. So since I purchase goods from Mr. Y on credit, I'm supposed to pay 50,000 to Mr. Y. So I have a liability to whom? I have a liability to Mr. Y. I'm liable for how much? I'm liable for 50,000. Here the liability is predetermined. How much I have to pay in future? 50,000. So when a liability is known to you, how much you are liable, the liability amount is pre-decided, fixed. You know the liability, how much you have to pay, then that's a liability. But provision is like there will be a payment, there will be a losses, but you cannot predetermine that. For example, I can say provision for bad debt. Provision for bad debt is an example of provision. I'm expecting that in future there will be bad debt losses, but I can't say how much losses there will be. Exactly, I can't say the amount. I know that there will be bad debts. It may be 5,000, 6,000, 7,000, 10,000. So what I do, I just estimate. Okay, maybe that 10% will be bad debt losses. So on the basis of that, I create a provision. So provision, how it is shown in the balance sheet? If it is against assets as a deduction from assets, and if it is against liability, then you can show it as a current liability also. So provision you can show under liability side as well as a deduction from debtors or a deduction from assets. So liability in one sentence I can say here the amount is determined, it's fixed. I know the exact amount, how much I have to pay. But in case of provisions, the amount is not determined. The amount cannot be decided in advance. I know there will be losses, but the exact amount I can't say. That is provisions. Okay, so liabilities though always come in the liability side. Provisions, it can be shown in the liability side as well as it can be shown as a deduction from the respective assets for which the provision is created. Provision for bad debt as it is shown as a deduction from debtors. Provision for some unseen liability that can be shown as a liability. Okay, provision for outstanding repairing bill or provision for anything else that can be shown as a liability. But when it is against the assets, that is deduction from that particular assets. So this is the concept of liability and provision. So four concepts I have discussed. Now the next is reserve versus provision. Reserve versus provision. What is reserve? What is provision? Reserve is basically when a business earns sufficient profit in a year, instead of distributing all the profits to the proprietors, part of the profit is kept aside. That is called general reserve or reserve. Reserve is basically appropriation of profit. Appropriation. Appropriation of profit means if there is profit in the business, then there can be reserve. A part of the profit is kept aside, that is reserve. But provision is even if there is no profit or there is inadequate profit, provision has to be created. So provision you can say it's a charge against profit. Whether there is profit or loss, provision has to be debited to profit and loss account. But reserve is not like that. If the business has sufficient profit, then only the reserve will be created. Now reserve, the amount in reserve that can be utilized for payment of dividend. Okay, when the company wants to pay dividend, then the reserve amount can be utilized for payment of dividend. But provision is created for a specific purpose. It can be utilized only for that purpose. If I create provision for bad debt, this provision amount can be utilized only for adjusting losses relating to bad debt. A company cannot pay dividend out of this provision. So reserve can be utilized for any purpose, but provision can be utilized for the purpose it was created. So reserve is appropriation of profit. If there is sufficient profit, then only reserve will be created. But provision has to be debited to profit and loss, even if there is inadequate profit or even if there is loss. Okay, so there's the main difference. So this two differences, if you keep in your mind, that will be sufficient to understand the difference between reserve and provisions. Okay, so five things I have discussed here. The first one was accounting for fixed assets. The second one was bad debt and provision for bad debt and resulting journal entries. Third thing, cash basis versus accrual basis of accounting. The fourth point, uh, liability versus provisions. What is liability and what is provisions? And the fifth thing is reserve versus provisions. So 5 things I have covered in this video. You please go through this video. I think it would be very much helpful to you, and you will be comfortable when you will appear for an interview. For other topics, wait for the next video. Thank you.